The lower Ethereum goes right now, though, WCCFTech thinks that the more the rip in the post-merge era will be Forceful. And I don't know that I agree with this. So let's go ahead and get into it. This is obviously an opinion piece. It's obviously WCCFTech. We've found a lot of issues with WCCFTech's articles surrounding crypto. And so I definitely take this with a huge grain of salt and probably throw it over my shoulder for a little bit of luck because, you know, I'm not feeling this necessarily, but let's talk about it. Ethereum has plunged around 22% from its recent highs of $2,021 recorded on the 13th of August, precipitated by moderation in erstwhile animal spirits that had taken hold of much of the risky asset universe amid expectations of an imminent dovish pivot by the U.S. Federal Reserve. Hammered by the budding risk-off sentiment as the meme stock mania 2.0 has apparently run out of fuel, coupled with an absolutely atrocious German PPI print, which again hammered home the likelihood of elevated structural inflation for the foreseeable future. Ethereum is experiencing a price correction right now, one which sets the stage for an even more outlandish rip in the post-merge phase. Investors and crypto dabblers generally assume that Ethereum's merge event will dramatically reduce the network's energy consumption and that any price upside would result from the ensuing ESG-related inflows. However, in reality, the merge event will introduce two major sources of intrinsic tailwinds that are likely to result in a rip-roaring gains for the world's second largest cryptocurrency market capitalization. See, I'm not seeing it here because what I'm seeing is the obvious correct argument that it's being directly negatively impacted by greater macroeconomic factors, especially with the new German PPI results and everything coming down from that. We have, of course, we'll get an idea in September on what the interest rates hikes will be in the US, which will definitely have an impact. And the removal of mining doesn't necessarily, it doesn't increase the value of cryptocurrency. It doesn't increase the value of Ethereum because you are now going to be in a position where you don't have that tie to a real world asset or a real world cost. And so I'm not necessarily sure that this is true personally. Currently, Ethereum is operating under proof of work, where miners authenticate and then incorporate transactions into the Ethereum blockchain, winning ETH-denominated rewards as compensation. And the thing is that means that because it's proof of work, it's directly tied to the cost of energy, which puts a value on the newly minted ETH. That's how that works. In proof of stake, it doesn't work that way, right? The merge will transition into proof of stake, where validators lock up a specific amount of Ethereum in dedicated nodes in order to compete with each other to authenticate transactions and introduce new blocks into the chain. Here, validators would no longer be required to run energy-intensive cryptographic calculations, as was the case under the proof of work model. Of course, here's the thing about that, though. Like I said, what determines that value to a certain extent is the amount of electricity it costs to mint the new ETH. This factor introduces the first major tailwind for Ethereum. A proof of stake dispensation is much more efficient, entailing energy cost reduction of around 99% relative to current levels. Before going further, let's discuss how Ethereum validators' rewards will be computed in the post-merge phase. The snippet above mentions variables that together determine how much reward each validator will receive for ensuring the network continues to operate smoothly. After the London hard fork, a base fee is determined or given level of network activity. This base fee is then burnt. Consequently, the validator's reward in the post-merge phase will predominantly consist of two variables. The tip fee, which is the cost incurred by the user to prioritize the processing of a particular transaction, and the block subsidy, which is fixed at 2 ETH per block and will be divided equally among all the validators. Given the increased efficiency of the network, and that's not necessarily true, we don't have full confirmation that it will be that exact setup, I don't think at this point, but given the increased efficiency of the network in the post-merge phase, transaction processing rewards are slated to fall precipitously. However, as costs plunge by a far greater percentage, Ethereum validators will experience an increase in staking yield. Also, at the prevailing price level, Ethereum miners are currently liquidating a large proportion of their mining rewards in order to cover the costs associated with running expensive mining rigs. This equates to around $18 million in selling pressure every day right now. The merge will reduce those energy costs by a whopping 99%. This means that validators would no longer be required to dump their Ethereum winnings into the market just to cover costs. But then what do you base the value off of? So this is a double-edged sword. The argument here is that to cover costs, Ethereum miners are selling the Ethereum to actually pay for some sort of real-world cost. In the case that you move into a position to where there is little to no real-world cost tied to the value of Ethereum, they are saying that essentially there will be no reason to sell it or liquidate it, and therefore driving the price up. In the short term, this could be true, but in any kind of investment, you are looking at trying to sell it. And we've talked about this. The Ethereum merge, and once it goes to proof of stake, means that people have Ethereum locked up and they will be generating revenue off of that locked up Ethereum. But those numbers come down, right? So the amount of ETH that they are generating compared to the amount of investment that they had to put in is very, very low. So what kind of selling pressure does that actually end up adding in later on down the line? Well, of course, we know that Ethereum will not have any sort of unstaking ability post-merge right away. So the threat of any sort of price pump selling pressure will be kind of thwarted at least until the next upgrade. But once that upgrade comes through, if the price goes up, the best way to generate revenue in a proof of stake scheme would be to unstake your Ethereum and sell it at the top of the market. What does this end up resulting in? This ends up resulting in a reduction of the security of the network. And so you're no longer incentivized to provide security to the network because your main incentive is to generate the revenue off of the actual price of ETH in relation to fiat, as opposed to the price of the power it costs to generate new ETH. This is the fundamental difference between proof of work and proof of stake, and how that would end up interpreting into the wider market later on. As per one estimate, the daily selling pressure from miners and validators would fall from 10,800 ETH to just 200 ETH. And once again, this means basically as a staker or a validator, what's your number one way to generate revenue at that point? Well, it's to sell your staked ETH at a high price. So you end up having large liquidation events that happen later on once they're allowed, because that's when people would be able to actually be able to sell it. And this means, from my perspective, at least right now, as I see it, post-merge right away, we could probably see an increase in the price because it'll be manipulated. You won't be able to actually unstake your ETH. But later on, this could mean a little bit more detrimental. So I could fall in line a little bit with their initial kind of theory here that post-merge right away, there will be an increase in the price. But overall, later on down the line, once that's unlocked, I think that flips on its head. This brings us to the crux of the matter. The combined effect of these two factors is expected to be truly deflationary for Ethereum. In fact, Ethereum's annual token issuance is expected to decline by a whopping 90% in the post-merge era, falling from the 5.5 million ETH per year to just 0.6 million ETH annually. For context, this reduction is equivalent to over 3 halving events for Bitcoin in a single go. The snippets above summarize the supply dynamics. As you can see, in the pre-merge phase, Ethereum is experiencing a supply growth of 2.5% per year, which is inflationary. However, in the post-merge phase, Ethereum will witness a deflationary reduction in the total supply of negative 1.6% per year. This creates a powerful intrinsic tailwinds for the cryptocurrency. Consequently, given these supply imbalances, the lower Ethereum goes right now, the more powerful will be the post-merge phase price dump. And so let's go ahead and look here. Let's see. So burn 2.5. Okay. Supply growth over 381 days. supply growth over 381 days, and the issuance. And that's simulating the merge. Okay, got it. So those are all the issues. I think I covered my points of view on it. I'd like to hear y'all's thoughts and opinions on this. Are you going to be holding ETH through the merge or selling it trying to sell it and time it right before the merge? And what would be the reason for that? Is it smart to go ahead and wait until post-merge, and if successful, you get a big pump in the price due to a successful merge and then sell? Or do you play it a little bit more safely in case there's also issues with the merge on release? Or finally, do you hold for the long term and wait for staking to actually be unlocked or unstaking to be available later on down the line? Thanks for checking out this clip from the Crypto Mining Show. You can check out the full episode here or more crypto content down here. Also, I'd like you to check out my locals page at sonofatech.locals.com, where you can become a member for free or choose to be a $5 a month supporter that unlocks additional content.